The year is August 2022. Gas hit €350 per megawatt hour, not a typo. Picture a utility executive in Berlin checking his screens at 6 a.m. The number doesn't make sense. Yesterday it was 200. Last month it was 50. By afternoon, his government is in crisis meetings. By evening, every industrial plant manager across Europe is doing the math they don't want to do. You know the number before anyone says it aloud. This is going to cost billions. But here's the trap. The bill didn't vanish. It moved. Russia had supplied 40% of Europe's natural gas. Then the invasion hit in February 2022, and the supply line stopped. Europe scrambled. They turned to LNG, liquefied natural gas from Qatar, Australia, the United States. LNG costs more to produce, more to ship, more to regasify. By summer, Europe was paying $100 per million thermal units, compared to $3 to $4 in 2019. This wasn't inflation. This was structural collapse. Demand didn't shrink. It got held hostage. And that hostage would pay the ransom, one way or another. Germany moved first. They announced €83.3 billion in energy subsidies for 2023 alone. France followed with €161 billion in total support. Austria, Belgium, Spain, Italy, every major economy opened its emergency fund. The European Commission counted €356 billion in total approved support by mid-2023. That's roughly the GDP of Belgium given away to suppress prices. Governments were paying families to heat their homes. They were capping electricity rates. They were subsidizing factories to stay open. The mechanism was clear. Make energy cheap again. Artificially. By January 2023, TTF gas prices had fallen from €350 back to 100. By summer, they hit 30. By early 2025, they stabilized at €31 per megawatt hour. The headlines called it solved. Energy returns to normal. Your electricity bills stopped climbing. Your neighbour could afford heat again. But the graphs told a darker story. The market price fell, not because supply was fixed. It fell because demand was destroyed. Factories closed. Production shifted. Deindustrialization became the unspoken solution. Not an energy crisis solved. It's an energy crisis redirected. BASF is Europe's largest chemical company. It runs a 10 square kilometre site in Ludwigshafen, Germany. Ammonia, methanol, plastics, fertilizer. In February 2023, BASF announced it was stopping ammonia production permanently. The company calculated the cost of keeping European plants running versus building new ones in Asia. Europe lost. By May 2024, they were auctioning off ammonia, methanol, and melamine plants. The ammonia plant moved to Louisiana. The methanol capacity went to the Middle East. This wasn't about energy prices anymore. It was about choosing Asia. And every other chemical producer was making the same calculation. Steel production follows the same pattern. In 2022, the EU produced 136 million tonnes. By 2023, that dropped 7.4% to 126 million tonnes. By 2024, capacity utilisation in flat steel hovered at just 65%. Plants that survived 2 world wars stood idle 35% of the time. Your pension probably owns those mills. Unemployment followed the closures. Communities dependent on a single factory faced slow hollowing. But the price cap stayed in place. The subsidy packages stayed in place. So the factories left instead. Not a temporary shutdown, it's a permanent displacement. Industrial production in the EU fell 1.5% in 2023 and 2.4% in 2024. 2 consecutive years of contraction. Capital goods fell 7.5%. Nobody called it deindustrialization. They called it recession. They called it external headwinds. The government subsidies masked the real mechanics. Your utility bill stayed manageable, so you didn't see the tax increases. You didn't see factory closures 200 kilometres away. Demand was destroyed not by economics but by geography. Energy-intensive industries that couldn't relocate had to close. Everything else moved. The cost was invisible because the bill was split across millions of taxpayers instead of concentrated at the meter. Germany's subsidy ceiling was 200 billion euros. France's support added 161 billion. Italy, Spain, Austria, and 20 other countries added another 150 billion combined. That's 511 billion euros redirected from future budgets. Where did it come from? Your taxes, deficit spending, central bank purchases of government bonds. In Germany, the average household saw no change in their electricity bill because the government suppressed the price. But that same family paid higher taxes next year to cover the subsidy they received. The bill moved from the utility meter to the tax form. Not all bills move equally. Energy-intensive industries got subsidies and stayed open longer. Small manufacturers got nothing. The pressure didn't release, it redistributed. European industrial firms needed two things: low energy costs to stay profitable, certainty those costs wouldn't spike again. The subsidies provided the first. They provided no certainty. A manufacturer in Germany knew his electricity was capped in 2023. But what about 2024? What about 2025? If the crisis returned, would the government intervene? Or would prices spike and margins dry up? The answer was unclear. So the capital allocation decision changed. European factories were upgraded less frequently. Research was slashed. New plants went to Bangkok and Shanghai instead of Stuttgart and Lyon. The cost of hedging against political risk was higher than relocation. The solution didn't create competitiveness, it destroyed it. Europe imported 80 billion cubic meters of LNG in 2021. By 2022, that surged to 130 billion cubic meters, a 60% jump. LNG from the US cost 3 to 4 times more than Russian pipeline gas at delivery. Qatar and Australia filled some gaps at premium prices. EU countries spent 258 billion euros on LNG imports from 2022 through June 2025. At 2019 prices, that same energy cost 60 billion euros, a 198 billion euro premium in just 3 years. But nobody counted it as a bill because it was dispersed across utility companies and consumer invoices. Security increased, margins compressed. Factories closed anyway, just somewhere else. The cost was real. The visibility was zero. BASF's Ludwigshafen auction in May 2024 wasn't the end. It was the announcement. The ammonia plant moved to Louisiana. The methanol went to the Middle East. Melamine shifted to Asia. Meanwhile, BASF approved a 10 billion euro investment in Zhanjiang, China, not Europe. ThyssenKrupp announced capacity cuts in Germany and Belgium. ASM Global sold off mills. The pattern was clear. European capacity was retired and replaced in regions with cheaper energy and stable policy. You don't see this on evening news because relocation isn't a single headline. It's a cascade of quiet boardroom decisions. Each decision made sense. Collectively, they represented structural shift that will take decades to reverse, if it can be at all. Germany's 200 billion euro emergency fund wasn't infinite. By late 2024, the government was debating how to extend it. Energy prices stabilised at 31 euros, but subsidy commitments were locked in. Germany's 2025 budget dedicated roughly 50 billion euros to energy support. That's 8% of the entire federal budget for one category. Over 10 years, cumulative subsidy spending could exceed 1 trillion euros across the EU. But the industrial base that generated tax revenue had shrunk. Smaller manufacturing base, plus higher subsidy spending, equals higher tax burden for shrinking productive workers. The bill moved from 2022 to 2032. It moved from utility companies to taxpayers. It moved from dispersed individual costs to concentrated future obligations. Not a crisis solved in 2023. It's a crisis extended through 2033. In 2021, the EU's manufacturing sector represented 9.2% of the global economy. By 2025, that number had shrunk. Not catastrophically, but measurably. Your smartphone has a Chinese power regulator that would have been built in Stuttgart 5 years ago. Your electric car battery chemistry was developed in Tokyo, not Munich. Your industrial control software comes from the United States, not Berlin. This wasn't inevitable. This was the price of the subsidy and demand destruction strategy. A Chinese steel mill got no subsidy. It operated at the energy price that existed. European mills got subsidies, but faced capital controls, regulatory uncertainty, and the knowledge their government couldn't protect them forever. The choice was rational. The outcome was predictable. Now the supply chains you might depend on in a real crisis run through regions you no longer control. In November 2025, EU industrial production posted its first real year-over-year gain in 3 years, up 2.2%. The headlines called it recovery. The energy crisis was over. But that 2.2% increase was built on a 6% smaller industrial base than 2021. Growth from a crater is still a crater. The factories that closed didn't reopen. The workers didn't return. BASF's ammonia plant in Louisiana was running at full capacity by late 2024. Ludwigshafen was being repurposed. The recovery is real. The rebound is happening. But somewhere else. Not a return to normal. It's a rebound from a new floor. Economists have a saying: you get what you measure. Europe measured energy as a problem to be solved with subsidies, not recognised as a signal to transform. Every subsidy implicitly said, keep using energy the way you always have. Consumption stayed high, bills stayed manageable, factories stayed open for a few more quarters. Then they closed anyway, just somewhere else. If the government had let prices spike and stayed there, the market would have made different choices. Factories would have invested in efficiency, consumers would have changed behaviour, industries would have consolidated. The transition would have been brutal and unequal, but it would have happened in Europe, not in Asia. Instead, the policy delayed the transition and moved it offshore. Both are painful. One preserves your industrial base, the other exports it. Back to that utility executive in Berlin in August 2022, when the €350 spike hit his screen. He didn't know it then, but his government was about to spend hundreds of billions to make the problem invisible. His electricity bill would be capped, subsidies would flow, the industrial parks would keep lights on through 2023 and 2024. But the real bill was being written in boardrooms across Europe. BASF, ThyssenKrupp, ArcelorMittal. Every energy-intensive manufacturer making the same calculation. Europe had made energy expensive in the long run by trying to make it cheap in the short run. The solution wasn't to fix the price, it was to fix the location. The bill didn't vanish. It moved from your utility bill to your taxes and your factories. And by the time you noticed, the relocation was already done.